With short-term interest rates now approaching 4.5% on 2-year Treasury notes, billionaire hedge fund manager Ray Dalio of Bridgewater Associates has recently declared cash is not trash. Now, Mr. Dalio started using the catchy phrase cash is trash quite a few years ago. We did a few podcasts in 2021 discussing this. He became notorious for it when he pronounced cash is trash from on high, both literally and figuratively, on January 21st, 2020, amongst the business and political elites in the mountains of Davos, Switzerland, at the World Economic Forum, also known as WEF. Then COVID hit, and the S&P 500 dropped over 35% in just 4 weeks. Then again, on Christmas Day in 2021, Mr. Ray Dalio put out a YouTube video, once again declaring cash is trash a mere week before the S&P 500 peaked at an all-time high and then fell over 25% in a little over 9 months. Then finally, on October 3rd, about 6 weeks ago, with the S&P 500 down almost 25% in 9 months and closing at near 2-year lows, but short-term interest rates approaching 4%, Mr. Dalio came out and declared, cash isn't trash anymore. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas. And before I address the notion that cash is trash or it's not trash for investors other than billionaires or 100-year time horizon endowments and pension funds that Bridgewater markets their funds to, make sure you click on the subscribe button as well as the notification bell so our team here can notify you when we upload our latest content. First off, I have never argued with the basic academic premise behind Mr. Dalio's original proclamation that cash is trash. His basic rationale has been that mushrooming money supply, as well as the government's money printing caused by our deficits, would eventually bring on inflationary pressures and a weakening of the dollar. So well, after nearly 30 years of deflationary pressures caused by 1, rapid technology adoption, 2, outsourcing our production and labor to cheaper continents like China, and 3, morphing and aging demographics here in the United States, a combination of Federal Reserve-backed stimulus and money printing, coupled with supply chain disruptions and an acceleration in baby boomer retirements, did finally inflect long-term inflation rates well above the Federal Reserve's 2% goal over the last 18 months. Man, that's a mouthful. What does that mean? It means inflation's gone up over the last 2 years. But the question is, should retail investors view or subscribe to the notion that cash is trash or not? That it's good or it's not? That cash is black or white? It's a yes or no. That's an investment alternative or not. And they should think of the world in terms of TINA, there is no alternative. If you have ever taken an economics class, you know that inflation is a tax. It's a tax on savers. It's a tax on those holding cash or other long-term fixed income investments. It's a tax on any asset that neither has pricing power to raise prices or offset inflation, nor maintains its own utility of use like a basic industrial commodity. Okay, so that's a lot of economic mumbo jumbo. So what does this mean to you? It means inflation is a consumption tax in reverse. So how is that? It's a tax on deferring consumption. If you don't buy a good or service today, it might cost you 5 or 10% more next month, next year. In a hyperinflation world, people see 100% to 500% inflation moves in crashing currency values. Examples of that are Venezuela and Turkey. Those are the most recent countries to experience hyperinflation. We aren't currently talking about that kind of inflation here in the United States, but we are now running much higher than the Federal Reserve's 2% inflation goal. So in Mr. Dalio's world, cash is either a yes or a no answer. In his world, both TINA, which means there is no alternative to equities, and FOMO, which is short for fear of missing out, rule the day in unison. And no rational investor would carry an investment cash allocation in their portfolios as you would be guaranteeing that you lose money versus inflation. Well, that was at least how he felt until October 3rd. In the finance world, if you sit in cash and inflation is higher than your cash return, you are doomed to a negative real return. In Mr. Dalio's asset allocation scheme, you would be 100% invested in something other than cash all the time. Every day, every week, every month, you would be all in, chips in the middle of the table, let the good times roll, volatility be damned, opportunity to buy in a down market, not possible because you have no cash. In Mr. Dalio's world, the greed factor outweighs one's need level in the investment and allocation equation. Investors, this might make rational sense to Mr. Dalio personally. He's a billionaire and doesn't need cash to pay bills. What bank in the world wouldn't lend him a little money to meet his monthly needs? What firm wouldn't advance him cash to buy an asset if he came to them and said he saw a great deal on a mispriced security? However, in very few words, in my opinion, is cash trash. In very few worlds do older investors not need cash, bonds, or other cash substitutes. In very few circumstances is it smart to be, I'm 100% long equity assets or other risk assets as a retiree or near retiree. And I would argue that cash is trash or not trash theory makes little sense to the rest of us, the other 99.99% of us who aren't billionaires. Let's look at Mr. Dalio's timing of his last 3 market timing calls on cash. Mr. Dalio's Davos, Switzerland cash is trash call on January 21st, 2020 couldn't have come at a worse time. It could go down in history as one of the worst market timing calls over the last 30 years, right in front of the global COVID economic shutdowns and market plunges. His hedge fund then suffered a minus 20% loss in the first quarter of 2020. He made follow-up calls like this each of the last 2 years, and amazingly, each time he has, within a period of say 1 to 7 days, the market has declined 5 to almost 25%. Cash is trash, and poof, here comes a pullback, correction, or bear market in stocks each time he's been on center stage saying this. Take a look at the chart of the S&P 500 in 2022 with Mr. Dalio's December 25th, Christmas 2021 YouTube video gift to investors marked on this chart, as well as his reversal for the first time in over 4 years on October 3rd, that cash is no longer trash, that Tina has been laid to waste, and 4% interest rates have buried her for good. Well, so far, October 3rd is almost the exact low in the S&P 500 in both price and time during this year's bear market move down. When it comes to thinking about and discussing and using cash, bonds, and other bond substitutes as investment categories, the investment team at Oak Harvest would much rather look towards another billionaire investor for an appropriate model. Who is that? That'd be Warren Buffett. As of last count, Mr. Buffett's company had over $105 billion in cash in short-term investments that include short-term bonds. Now, Mr. Buffett is probably showing small capital losses on those bonds like all retail investors are. However, Mr. Buffett has been quoted in a shareholder letter as saying this, quote, "I will never risk getting caught short of cash." Now, why does he say this? First, he probably says this because Mr. Buffett, while he doesn't need a dime of cash, given his own net worth, knows that having some cash lying around in the form of short-term liquid instruments or short-term bonds gives an investor an option to buy things that when things go bad for other people. It allows one flexibility to jump on opportunities and others' mistakes when misfortune comes to town or the overall economy hits a recession or a slowdown like we're in right now. And viewers, secondly, and probably more importantly, and less talked about for pre-retirees and retirees, is that Mr. Buffett knows that the sequence of investor returns is almost as important to an investor as one's total compounded return, especially for those nearing or in retirement. Is having cash a binary decision? Is cash trash or is it not trash? Is it a yes or a no like Mr. Dalio makes it out to be? Not at all, not in my book, not in Oak Harvest's book. With the volatility that the stock and bond markets have experienced in 2022, our investment team recommends that you get on the phone and give our Oak Harvest team a call and ask to speak to one of our financial advisors and planners. Set up a meeting, sit down with one of our team members, and let us walk you through how the sequence of return can affect your retirement plan every bit or more than the average investment return you generate with your current advisor. Give us a call at 877-896-0040 and give our retirement planning team a chance to help you with your investment allocation and have our financial planning team model your cash needs and greeds into and through your retirement years. Whether your cash account is yielding a few basis points or a few percentage points, the entire Oak Harvest team is here to help you navigate into and through your retirement years. For myself and the whole team here at Oak Harvest, have a great weekend.